Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing TransDigm's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 74 billion market cap. They're trading at $13.18 a share. Pretty expensive stock price, and it's 56 million shares outstanding. They have a low share count, so they don't split. That's why their stock price gets so high. TransDigm develops and manufactures engineered aerospace components. It was founded in 1993 when 4 industrial aerospace companies were combined by a private equity firm in a leveraged buyout. The company expanded the range of aerospace components it manufactures through acquisitions over the years. It filed an IPO on the New York Stock Exchange in 2006. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doubled from 800 million to 1.6 billion. Really nice growth and good margins. Free cash flow margin of 22%. Net income is a profit or loss on the income statement. It's revenue minus expenses. That more than doubled from 700 million to 1.6 billion. Also really nice margins, north of 20%. Revenue is a sales for the company, and that goes up each year from 4.8 billion to 5.4 billion to 6.6 to 7.3. Really impressive growth. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 67 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $58 billion. We divide that by 56 million shares. And we get a calculated stock price of 1,000. They're trading at 1,300, so they're trading at a 28% premium. It's a sell according to the model. There are 70 companies in the same industry as TransDigm, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 157 million in CapEx, a lot lower than most companies, but higher than the median. We can't look at their debt to equity ratio. They have negative equity. That means their liabilities are higher than their assets. They do not pay a dividend. They generate a good amount of free cash flow, 1.6 billion. They rank 6th in market cap. We can't look at their price to book, negative equity. Their PE is worse than the median average. Price to free cash flow is better than the average, but worse than the median. And they're trading at 10 times revenue. So they don't really generate that much revenue relative to their market cap. Besides Axon, they have the worst price sales ratio on this list. But they are growing. That's why their stock price keeps going up. Their 5-year annual revenue growth rate is 12%. L3Harris is 25%. Axon is number 1 at 31%. If you were shrewd enough to put $10,000 into this company 10 years ago, you'd have $116,000 today. That's a 28% annual return, over a 1,000% total return. Let's take a look at their most recent 10Q. We'll start with the income statement. It went up a lot in the first quarter of 2024, 1.9 billion, up from 1.6 billion. Let's see if they give a breakdown of the 1.9 billion. Pretty much half their revenue is power and control. The other half is airframe. In power and control, 420 million in defense. Then you have 290 million of commercial and non-aerospace aftermarket. And then 200 million of OEM, original equipment manufacturer. In airframe, it's pretty much split. 300 million in each of these 3 categories. And then 46 million of non-aviation. Their cost of revenue, all the expenses directly tied to generating the revenue, 767 million, which is 40% of their revenue, down from last year of 42%. SG&A, selling general administrative expenses, 250 million, that's up. It was 12.5%, now it's almost 13%. Operating income is better than last year. Last year was 43.7%, now it's 45%. And they pay 326 million of interest on their debt, higher than last year, but lower as a percent of their revenue. Their operating income, 400 million, which is 21%, last year 19%. Net income of 400 million, up from 300 million. EPS of 7, up from 532. They did add shares. It was 57.1 million last year, now it's 57.8 million. EBITDA looks good, 757 million to 919 million. Let's take a look at their balance sheet. Current assets, $8.3 billion. Current liabilities, $2.2 billion. A really high current ratio. It's almost a 4. They have a lot of cash, $4.3 billion. $1.2 billion of accounts receivables. This is how much money other companies owe them when they sell on credit. $1.8 billion of inventory. Here's a breakdown of the inventory. $1.2 billion of raw materials, $500 million of work in progress, and $240 million of finished goods. Their biggest asset is goodwill. This is from acquisitions. About half their goodwill is power and control companies, the other half airframe. To fund their acquisition of Electron Device Business, they issued a $1 billion note, and they pay 7 1/4 interest on that note. Pretty high interest rate. Total assets $22 billion, up from $20 billion. Total liabilities $25 billion, up from $22 billion. They have a lot of long-term debt, $21 billion. Here's a breakdown of the long-term debt. Nothing is due until 2027. About $3.2 billion due that year. 2028, $2 billion. 2029, $1.2 billion plus $700 million plus another $2.7 billion. Then you have 2030, 2031, and 32. Assets minus liabilities equals equity. They have negative equity because their assets are $3 billion less than their liabilities. You can see assets $21 billion, liabilities $24 billion. They raised $2.7 billion from selling their business. They lost $4 billion from running their business, and they bought back $1.7 billion of their own stock. Let's look at the statement of cash flows. Operating cash flow $865 million. That's up from $500 million. Operating cash flow is net income, plus you add back the non-cash items on the income statement, like amortization, also stock-based compensation, $111 million. And then you have to adjust for changes in working capital. They bought inventory, so that was a cash outflow of $114 million. In their investing section, they spent $84 million in CapEx. These are the investments in property, plant, and equipment. $87 million in acquisitions. The $87 million was from the acquisition of FPT. Their subsidiary DART acquired all the outstanding stock of FPT. In their financing section, they paid out $2 billion of dividends. They issued $6 billion on a senior secured note. They paid back $4.4 billion on a secured note. They added $2.7 billion of term loans. They repaid $1.7 billion of term loans. Let's look at the stock on Simply Wall Street. Its last price $13.40, $74 billion market cap, down 0.5% in the past week, up 69% in the past year. Let's see what they say about the company. TransDigm designs, produces, and supplies aircraft components in the US and around the world. They were incorporated in 1993, based in Cleveland, Ohio. Here's the stock price since they started trading in 2006. It started at $25 a share, and it took 4 years to double. It was $51 in 2010. Then another 2 years to double, $100 in 2012. Then 3 years to double again, $200 in 2015. Then 4 years to double, $400 in 2019. Then another 4 years to double again, $800 in 2023. And this stock is a rocket ship. Look how much it's gone up, crossing past $1,300 a share. Simply Wall Street's valuation is $1,400. They say it's 4% undervalued. 21 analysts priced this stock at $14.20. Their revenue forecast for 2024 is $8 billion, then $8.5 billion, then over $9 billion in 2026. Free cash flow forecast for 2024 is $1.9 billion, then $2.3 billion, then $2.6 billion. Lots of growth for this company. Look how much their revenue has gone up over the years. It was $1.8 billion in 2013, then $6 billion in 2020. It did come down in 2021 to $4.5 billion, but now it's over $7 billion currently. This red line is their debt, and it went from $4 billion in 2013 to $22 billion in 2024. And their equity has also been getting worse. Their equity is negative $3 billion. And this green line is their cash. They have $4.3 billion of cash on their balance sheet. They did pay one dividend. It must have been a special dividend, because most companies don't just pay one dividend. They pay consistently. The CEO's salary went from $700,000 to $1.4 million. Total compensation $24 million. Tenure as CEO 7 years. In the past year, mostly insider selling, a couple of really small buys, and almost all the companies owned by institutions. The biggest shareholders: Capital Research, Vanguard, BlackRock. Then you have JP Morgan, Norges, Morgan Stanley, Invesco, Schwab. And their employee count went from 6,100 to 18,000, but then it came down to 15,000. And the ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Mexican Bolsa, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.